Welcome to BFSI classes, Domain Business Correspondent, Chapter RBI and Regulatory Systems. RBI is the apex authority to control all commercial banks in India, and it was formed on April 1st, 1935 based on Hilton and Young Commission report appointed by British government. Even though Kolkata was the first headquarters of RBI, at present it is headquartered at Mumbai. It was also the central bank of Myanmar up to 1947. Now, let us get into the main functions of RBI. There are mainly 6 functions performed by RBI as a central monetary authority of India. They are Monetary Authority, Bankers Bank, Banker to Government, Controller of Credit, Custodian of Forex, Promotional Functions. Now let us look deep into these points as turn by turn. First one, Monetary Authority. This function is performed by RBI as per Section 22 of the RBI Act 1934. As per this section, RBI is the sole authority to issue currency notes except rupee 1. 1 rupee notes are issued by Ministry of Finance of Government of India. In order to print currencies, RBI need to keep reserves in forms of gold and other government securities. Up to 1956, India was followed a proportional reserve system. But from 1956, India follows minimum reserve system. That means RBI need to keep minimum 40% of reserves to print any volume of currency notes. This reserve can be in form of gold or government securities. Second function, Bankers Bank. RBI acts as banker of all commercial banks in India. RBI holds a part of cash balances of the commercial banks, and RBI also acts as a clearing house of all commercial banks. It refers to that all government bills with the commercial bank to be cleared through RBI. RBI also provides cheap remittance facilities to the commercial banks. It also acts as the lender of last resort. Third function, Banker to Government. RBI acts as banker to central and state governments. It accepts deposits from central and state governments. It also makes payments on behalf of the government in accordance with their instructions. And RBI collects the recent information on current economic and financial developments in India. Fourth function, Controller of Credit. One of the vital functions of RBI is that it acts as a controller of credit. RBI undertakes the responsibility of controlling credit to ensure internal price stability and promote sufficient credit for the economic growth of the country. Credit control is done to ensure there is no inflationary tendency in the economy and there is no deflationary tendency in the economy. So, in order to balance the economy from inflation and deflation, the credit control measures taken by RBI, and these credit control measures include both quantitative and qualitative measures. Now, let us discuss these measures in detail. First one, quantitative measures. Quantitative measures refer to those measures in which RBI takes measures to correct money supply imbalances using various rates of interest. These are indirect measures to control inflation or deflation. By increasing or decreasing these rates, RBI indirectly controls inflation or deflation in the economy. First one, bank rate policy. Bank rate is the lending rate of the central bank. It is the official minimum rate at which Central Bank of a country rediscounts the eligible bills of exchange of the commercial banks and other financial institutions. RBI either increases or decreases bank rate to adjust money supply imbalances. In times of inflation, RBI increases bank rate, and in times of deflation, RBI decreases the bank rate. Cash reserve ratio. CRR is a percentage of net demand and time liabilities that to be kept with the RBI by all commercial banks. If CRR is increased, the capacity of commercial banks to lend money will be reduced, and thereby the supply of money and inflation can be controlled. If it is reduced, the vice versa is the phenomenon. If there is inflation, CRR increases, and if there is deflation, CRR decreases. Statutory liquidity ratio. Statutory liquidity ratio is a percentage of net demand and time liabilities that to be kept by all commercial banks with the banks itself. Just like CRR, when there is inflation, SLR increases, and when there is deflation, SLR decreases. Repo rate. Repo rate is the rate at which RBI lends money to the commercial banks against government securities for a short period of time. When there is inflation, RBI increases the repo rate. When there is deflation, RBI decreases the repo rate. Reverse repo rate. Reverse repo rate is the rate at which commercial banks deposits money with the RBI for a short period of time. In short, it is the deposit interest rate provided by RBI to commercial banks. When there is inflation, repo rate increases. When there is deflation, repo rate decreases. Open market operations. Open market operation is the process of buying and selling of government securities in the open market by the Reserve Bank of India. When there is inflation, RBI sells the securities, and where is the deflation, the securities are bought by RBI. Now let us look into the qualitative measures. First one, rationing of credit. It refers to setting of minimum and maximum limits to the loans for the commercial banks to disburse. That means a minimum this much loans to be given, and a maximum limit, that is maximum this limit is only a bank can provide as loans. Okay, this setting is known as rationing of credit. Just like the ration shop in the public distribution system, each family is allotted a certain ration. Okay. Margin requirements. Margin requirement refers to tightening of margins for the loan to each customers. For each customers, there will be a margin for loans. No loans will be provided beyond that margin. Moral persuasion. Moral persuasion means RBI directs other commercial banks to strictly follow these guidelines of RBI and warns those banks who violate the rules of RBI. RBI do this moral persuasion to keep the banks in track of RBI and save the economy from deflation and inflation. Direct action. When moral persuasion fails, RBI takes direct action against those banks who violate the rules and regulations of RBI. Publicity. When direct action fails, RBI gives publicity in newspapers and other media about the norms violating banks. Next function, custodian of foreign exchange reserve. In India, forex reserves are held with the RBI, or RBI is the ultimate custodian of foreign exchange in India. That means commercial banks need RBI permission to transact foreign exchange in India. In India, foreign exchange is regulated under the Foreign Exchange Regulation Act, that is FERA Act, which was passed in 1973. In 2001, FERA renamed as FEMA, which is abbreviated as Foreign Exchange Management Act. Last function is promotional function. RBI promotes various development banks in India like SIDBI, IDBI, etc. It controls NABARD, IDBI, ICICI, etc. These are the developmental banks in India. NABARD is the apex body of agriculture sector in India and disburses loans for agriculture sector. That's all for this session. We will meet in another session for other videos. So till then, bye.